Welcome to the Poseidon Finance channel. Do me a favor and hit the like and subscribe button. Let's get started. State Farm walked away from California in May of 2023. Walked, didn't fail, didn't go bankrupt. They walked. The largest home insurer in the country, sitting on something like $140 billion in surplus, looked at the numbers on California houses and decided those houses were no longer a line of business it wanted to be in. 9 months later, give or take, Allstate did the same thing. Farmers tightened up. The smaller carriers, the ones you've never heard of unless you're inside the industry, they were already gone. So, what I want to do today is tell you why this is happening, because the story you've been told, climate change, wildfires, hurricanes, you know the script, is technically correct and also missing the entire mechanism. Here's the claim, and I want you to sit with this for a second before I defend it. Florida and California are not uninsurable because of fires and storms. Florida and California are uninsurable because the political and regulatory architecture of those two states, layered on top of a global reinsurance market that repriced climate risk somewhere around 2017, has produced a feedback loop that the system cannot exit without breaking something the politicians are not willing to break. That's the lecture. The rest of what I'm going to say for the next 30 minutes is just me showing my work. Now, and this is where it gets uncomfortable for the people on the policy side, most of what you read in the New York Times or the Wall Street Journal about this is not wrong. It's just at the wrong level of analysis. They'll tell you about Pacific Palisades. They'll tell you about Hurricane Ian. They'll show you a chart of Citizens Property Insurance growing from 400,000 policies to 1.5 million. All true. None of that is the story. The story is happening in Bermuda. The story is happening in a glass building in London where a syndicate underwriter at Lloyd's is deciding what to charge a Florida primary carrier for catastrophe coverage at the upcoming June renewal. That number, that single decision, made by maybe 100 people on the planet, that is what is breaking Florida and California, not the storms, the price of insuring against the storms. I want to give you a way of seeing this that comes from outside finance, because the analogies inside finance are too gentle. Think about a nuclear reactor. A reactor is stable, not because nothing inside it is dangerous, but because every dangerous tendency is offset by a control system designed to push back against it. Now imagine that by political decision, you remove some of those control rods. The reactor doesn't explode the next day. It runs hot for a while. It looks fine, right up until the moment it isn't fine. That's where we are. The control rods came out in 1988 in California and around 1993 in Florida, and the reactor has been running hotter every year since. We are watching the temperature climb in real time and pretending the gauge is broken. Before anybody tells me I'm being too dramatic, look, I'm not. I sat with a former student about, maybe 18 months ago, 2 years ago, at a coffee shop in Stamford. He was running at the time a fairly substantial catastrophe bond book at one of the larger reinsurers. And he said something to me that I have not stopped thinking about. He told me the climate models and the actuarial systems aren't even the binding constraint anymore. The binding constraint is that the same houses in the same wildfire corridors and the same surge zones are now worth 4 times what they were worth in 2005. So even if the storms were exactly as frequent and exactly as intense as they were 30 years ago, which they aren't, but pretend, the dollar exposure has gone up enormously because we built mansions where there used to be cabins. That's a number that doesn't get talked about much. We're going to come back to it. Roger Pielke at Colorado has been making a version of this argument in print for 20 years and getting yelled at for it. He's basically right, and the political incentive structure makes him impossible to engage with honestly, which is its own conversation. I want to plant a flag for what we're going to cover. By the end of this lecture, you will understand 4 things that are deliberately not taught in undergraduate finance courses because they're not in the textbooks. The people who deal with this on a daily basis don't write textbooks. They trade catastrophe risk for a living, and they make a lot of money keeping their insights private. You will understand why Proposition 103, which Californians passed in 1988 thinking they were protecting consumers, is the single most important reason their insurance market is collapsing today. You will understand why Florida's litigation architecture, and not the hurricanes, pushed 11 primary carriers into insolvency between 2017 and 2022. You will understand the reinsurance death spiral, which is a phrase actuaries use in private and almost never in public. And you will understand a thing I'm going to call the insurer of last resort trap, which is, in my view, the most underappreciated systemic risk in the American financial system right now. More than commercial real estate, more than regional banks. I will defend that. Okay, that's the roadmap. One more thing before we move on, because somebody asked me this in office hours last week, and it's a fair question. The question was, why don't insurers just charge whatever they need to charge to make money? If a house in Malibu costs $40,000 a year to insure, charge $40,000 a year. Market clears. Problem solved. This is the question every economics undergrad asks, and it sounds so reasonable that nobody in this room is going to feel embarrassed for not knowing the answer. I'm going to come back to it in section 4. The short answer is they're not allowed to. The slightly longer answer, which is more interesting, is that they wouldn't even if they were allowed to, because of a thing called adverse selection that breaks insurance markets in a way that doesn't break, say, the market for haircuts. Let's keep moving. Open your finance textbook to the chapter on insurance, and you will read, almost word for word in every textbook printed in the last 60 years, the same explanation. Insurance works because of the law of large numbers. You take 1,000 homes, each with a small independent probability of burning down, and the statistical aggregate is wildly more predictable than any individual home. You charge each homeowner a small premium. You pay out claims to the unlucky few. The pool absorbs the variance. Everybody wins. That is the textbook. That is what you got tested on. It is also, for our purposes, almost completely useless. The word that does the load-bearing work in that explanation is independent. The risks have to be independent. Your house burning down has to be a roughly uncorrelated event with my house burning down. If your house and my house and 70,000 houses in our zip code can all burn down on the same Tuesday because the wind shifted, which is what happened in Paradise, California in November of 2018, the law of large numbers does not save you. The law of large numbers actively betrays you. Your premium pool, which was designed to handle a thin trickle of independent claims, has to absorb a tidal wave of perfectly correlated claims. $17 billion in insured losses in something like 4 hours. Howard Kunruther, he's an insurance economist at Penn who's been writing about this since before most people in this room were born, has a phrase I like. He calls catastrophic risk fat-tailed and dependent. Fat-tailed meaning the rare events are much more devastating than the normal distribution would predict. Dependent meaning the risks correlate during exactly the moments you needed them to be uncorrelated. Both features break the insurance pool. Both features are getting worse. And this is the part that makes me want to scream when I read coverage of this stuff. Both features were already known and modeled and partially priced into reinsurance markets 15 years ago. The fact that primary insurers are surprised about it now is itself a story about regulatory capture. We'll come back to that. I want to give you a cross-domain image, because this gets abstract very quickly. Think about a swimming pool. A normal pool has a few people splashing, a few people swimming laps, a kid jumping in here and there. Each disturbance is small and uncorrelated, and the surface stays roughly flat, because the disturbances cancel out. That is normal insurance. Now imagine instead that every once in a while, on no particular schedule, every single person in the pool jumps at exactly the same instant. The water doesn't stay flat. The water doesn't slosh. The water explodes out of the pool. The structure cannot contain the correlated event. That is catastrophe insurance. And the architecture you built to handle the splashing, your pool walls, your tile, your filtration system, is destroyed. Not because the people in the pool got bigger, because they synchronized. I had a colleague years ago, actually, I don't want to name him because he's still in the industry and he'd be embarrassed, who used to run pricing at a Bermuda reinsurer in the late 1990s. He told me something I think about every time I see a news story about an insurance crisis. He said the dirty secret of catastrophe pricing is that you can never charge enough for tail risk, because if you charge what the model says, no customer will buy from you, because they don't believe the model. They look at the last 20 years, they don't see the bad event, they think you're price gouging. So you charge less than the model. You hope the bad year doesn't happen on your watch. Every 20 years or so, somebody's wrong, and a lot of people lose a lot of money very quickly. That's the industry. That's the actual industry. Every other description of it is marketing. Now, stay with me because there's a wrinkle in the textbook story that I want to put pressure on. Earlier I told you the law of large numbers requires independent risks. I want to partially take that back. The truth is more uncomfortable. Even when risks are dependent, you can still build an insurance pool, but only if the dependence is bounded and known. You can model correlated wildfire risk in California, and the math works out as long as you can get a high enough premium. The market should clear, the model should price the correlation, insurance should still function. It doesn't in California, for one specific reason. And I want to give you a number. In California, the state regulator, under a law I'm going to spend a lot of time on later, does not allow insurers to use catastrophe models in their pricing. Forward-looking models, the kind reinsurers have been using since 1987. California requires you to price wildfire risk based on a 20-year backward-looking average of actual losses, 20 years backward, in a system where the actual loss curve has gone vertical in the last 5. You cannot price tomorrow's risk if you are required by law to look only at yesterday's experience, and yesterday's experience does not contain tomorrow's risk. That's not a market failure, that's a statute. Pause on that. Right, let me complicate one more piece of the textbook story before we get to history. The textbook will tell you that diversification fixes correlation. Hold a portfolio of different kinds of risk, Florida hurricanes, California fires, Tokyo earthquakes, and the portfolio is more stable than any individual exposure because the risks aren't correlated with each other. Mostly true, almost true. There's a hidden correlation that the textbook doesn't mention, and the hidden correlation is capital. After a major loss event anywhere on the planet, global reinsurance capital contracts, The same Bermuda reinsurer that just paid out $3 billion on a Japanese earthquake is also the one writing your Florida hurricane cover. When their capital takes a hit, they raise prices everywhere. The supposedly diversified system turns out to be coupled through the balance sheets of the people writing the protection. That's the load-bearing fact almost nobody outside the industry knows. The system looks diversified to a regulator. It is not diversified to a reinsurer, and it's the reinsurer's view that determines whether your house is insurable next June. 1992, Hurricane Andrew makes landfall in southern Florida. Cat 5 at the eye wall, winds maybe 170 miles an hour, surge 12 to 17 feet. Insured losses, depending on whose number you trust, somewhere around $15 to $25 billion in the dollars of the day, which translates to something like 40 to 50 billion in current money. That is a number, but it is not the number that matters. The number that matters is 11. 11 primary insurance companies were rendered insolvent by Andrew. 11 companies that had been in business in some cases for 50 years, that were rated A or better by the rating agencies, that had reserves that looked completely adequate on a Friday afternoon. By the following Wednesday, they were gone. Wiped. The state of Florida had to take over their books or transfer them to surviving carriers. In the process, the legislature realized something that should have been obvious, but wasn't. The entire Florida insurance market was operating on assumptions about hurricane frequency that turned out to be optimistic by something like a factor of 3. What's the story you've been told about this? You've been told that Andrew was a wake-up call, that the insurance industry got smarter, that catastrophe modeling came in and saved everybody. That's a story. It's the official story. It's about a quarter of the actual story. The actual story, and this is where you have to know about Karen Clark, who almost nobody outside this industry has heard of, but who is one of the most consequential figures in 20th century financial services, is that catastrophe modeling existed before Andrew. Karen Clark founded a company called AIR Worldwide in, I believe, 1987, maybe 86, where she was building probabilistic models of hurricane risk based on historical data and physical simulation. She went around to insurance companies in the late 1980s trying to sell her models, and they laughed at her. Literally laughed. She would give presentations and tell them, here is what your portfolio looks like in a 1 in 100-year hurricane scenario, and the loss number was so far above what the actuaries thought possible that the actuaries assumed she was wrong. That's the part that gets left out of the official story. She wasn't predicting Andrew. She was telling them Andrew, or something exactly like it, was overdue. They didn't want to hear it because pricing in her model would have made their business uneconomic. They preferred their own models, which were actuarial, backward-looking, and wrong. I read her early papers in graduate school. I think it was in a financial econometrics seminar. Must have been 99, 2000, and I remember thinking, this can't be right. 6 months later, I was convinced she was right and the entire industry was wrong. The entire industry took another 7 years to admit it. That's a digression from a digression, but I want you to feel how slow this stuff moves. The information existed, the models existed. The industry chose not to use them because using them would have priced their products out of the market. Skip across the country. 1994. Northridge earthquake. Insured losses, something like 15 to 18 billion of the day's dollars. Here's a thing that almost nobody who didn't live through it remembers. After Northridge, every single major homeowners insurer in California stopped writing earthquake coverage. Stopped completely. The political response, instead of letting the market reprice or letting the coverage simply disappear, was to create the California Earthquake Authority, which is a state-affiliated entity that pools earthquake risk and issues a mostly not very good earthquake policy that almost nobody actually buys. Today, somewhere around 10% of California homeowners have earthquake insurance. 10%? In a state where one of the largest earthquakes in modern history would generate insured losses in the hundreds of billions. The system response to a tail event in California in 1994 was institutional retreat, not repricing. Remember that response. We're going to see it again. Now here's the part that nobody puts together. 6 years before Northridge, in 1988, California passed Proposition 103. It was sold as a consumer protection measure. Ralph Nader pushed for it. The campaign material talked about insurance company gouging and the need for democratic oversight of rates. I'm going to summarize a 40-page statute in 2 sentences, which is unfair, but here we go. Proposition 103 required that all insurance rate increases above a small threshold be approved in advance by the elected California Insurance Commissioner. Proposition 103 implemented this system by reference to historical loss data, not forward-looking modeling. So the very tools that Karen Clark had been pioneering in the mid-1980s to price catastrophe risk, the tools that the rest of the world was about to start using, were, in California, by statute, inadmissible in rate hearings from 1988 onward. Read that twice. The state most exposed to wildfires, with the most expensive housing stock in the country, by popular referendum, prohibited its insurance industry from using the only mathematical tools that could correctly price its risk. There's a thing in military history I think about a lot in this context. The Maginot Line, The French defensive fortification on the German border is constantly mocked for having failed in 1940 when the Germans went around it through Belgium. But the Maginot Line was not stupid. It was world-class engineering. It was the most sophisticated static defense ever built. It was designed to fight the war the French had just fought, which was the First World War, where the front lines barely moved for 4 years. In that war, the Maginot Line would have been decisive. It just wasn't fighting that war anymore. That's 1988, Proposition 103. That's 1993, Citizens Property Insurance, which Florida created as its insurer of last resort right after Andrew. That's the entire architecture of American catastrophe insurance, built brilliantly by smart people to fight the last war. And the climate has gone around it through Belgium. People will tell you the Florida and California insurance crises are about climate change. The crises were architecturally guaranteed by structural decisions made in 1988 in California and in the early 1990s in Florida. Climate change is making the problem worse. Climate change is not the problem. The problem is that we built a system to handle the world of 1970. We forgot that the world keeps changing. We forgot that political systems do not voluntarily reform until something breaks. Anyway, that's the history you don't read in the trade press. Let's look at the actual mechanism. Let me give you the mechanism, the way it actually works, the way I would teach it on the first day of a graduate insurance seminar, which I do every fall, and the students always look slightly betrayed when they realize how different it is from what they read. A primary insurer, call it State Farm, call it Allstate, doesn't matter, takes your premium. Let's say you pay them $4,000 a year for your homeowner's policy. State Farm doesn't sit on that $4,000 and wait for you to file a claim. State Farm, on the back end of that policy, immediately gives away most of the catastrophe exposure. It buys reinsurance. The reinsurance is structured in layers, like a building. The bottom layer, the working layer, covers ordinary losses. A kitchen fire here, a tree limb through a window there. State Farm keeps that. The middle layer covers larger but still expected losses. State Farm keeps some, gives away some. And the top layers cover the catastrophe scenarios, the hurricane, the wildfire, and almost all of that is given away. Not because State Farm is reckless or smart or lazy, because that is the only way the math works. A primary insurer that retained all of its catastrophe risk would have a balance sheet that was, in the actuarial language, hilariously inadequate. They would all be insolvent on day one, so they buy protection. The protection comes from reinsurers. The reinsurance industry, and this is going to sound strange the first time you hear it, is concentrated geographically in 3 places on the planet. London, where you have Lloyd's of London and the syndicates. Bermuda, which is a small island in the Atlantic that became a reinsurance hub for tax reasons starting in the 1970s. And Munich, where you have Munich Re and Hanover Re, the German giants, joined by Swiss Re a few hundred kilometers away. There are reinsurers in other places, but if you're talking about catastrophe coverage for North American property risks, your primary insurer is buying protection from people in those 3 cities, maybe 100 firms total, maybe a few thousand individual underwriters. That's the entire planet's catastrophe pricing apparatus. I sat in on a reinsurance renewal meeting once. I shouldn't say where. The firm asked me not to say. And what struck me was how informal it was. You have a primary insurer's chief actuary on one side of a table. You have 3 or 4 reinsurance underwriters on the other side. Spreadsheets sliding across the table. An argument about a Greek letter that represents some specific tail correlation. In a single afternoon, they negotiate the price of catastrophe coverage for thousands and thousands of homes that the people in those homes have never heard of. The number they settle on, that gets baked into the primary insurer's costs. That gets passed through, partly or wholly, to your premium. You will never see that meeting. Almost no one will. But your insurance premium is downstream of it. Now, June 1 of every year is when most North American hurricane reinsurance renews. It is the most concentrated date in the global financial calendar that nobody outside the industry has ever heard of. June 1st, 2023, was the worst reinsurance renewal in modern memory. Catastrophe reinsurance rates on average went up something like 40 to 50%. For Florida property risks, specifically, in some cases more than that. Why? Hurricane Ian, which had hit the previous September, had cost the global reinsurance market somewhere around $50 to $60 billion in insured losses, of which a substantial fraction landed on the reinsurers. Their capital was depleted, their cost of capital had gone up, they demanded better pricing to redeploy. The primary insurers had to pay it or go without coverage. They paid. Right. Here's the analogy that I find clarifying. Think about how dams used to be designed. The standard, going back to the early 20th century, was the so-called 100-year flood. You build the dam tall enough and strong enough that a flood event with a 1% probability of occurring in any given year, meaning it happens, on average, once a century, won't overtop the dam. That was the standard. It was a sensible standard. The problem was that the 100-year flood was calculated using historical data going back maybe 60 or 70 years. So you were extrapolating a centennial event from less than a century of observation, and This is the part dam engineers in the 1980s started to realize. Climate variability was making your historical sample non-stationary. The flood that had a 1% annual probability in 1940 did not have a 1% annual probability in 1980. The probability had drifted. Your dam was undersized for the world you are now living in, even though it had been correctly sized for the world you had measured. That is exactly what happened to the catastrophe reinsurance market between roughly 2015 and 2022. The frequency and severity assumptions baked into reinsurance pricing turned out to be drifting. Actual losses kept exceeding modeled expected losses. A few of the bigger reinsurers got crushed in 2017 by Harvey, Irma, and Maria, about $100 billion of insured losses in one season. Some of them got crushed again in 2018 by California fires. By 2022, after Ian, the global reinsurance market basically said, "We are repricing. We are not selling capacity at the old rates. If you want our capital, you are going to pay for it." That's the moment the entire American property insurance system started to crack, because primary insurers in Florida and California suddenly faced reinsurance bills that were 40, 50, 60% higher, and they had to do something about it. In Florida, they were allowed to pass those costs through to consumers, mostly, and so Florida homeowners saw premium increases of 40, 50, even 100% in some markets. That was bad. In California, because of Prop 103, they were not allowed to pass those costs through. They were forced to absorb the higher reinsurance costs out of their own surplus. That was worse. A rational primary insurer, looking at California, did the only thing that made sense. It stopped writing new business. Some stopped renewing existing business. State Farm was the most visible. State Farm was not the first. And State Farm will not be the last. That's the surface layer. There's a deeper layer underneath this, what the reinsurers were actually doing, why their capital costs went up, where the catastrophe bond market fits in, why certain risks became uninsurable at any price, and we need to go there next, because the surface layer doesn't tell you why this is going to keep getting worse for at least another decade. So the surface layer is primary insurers buy reinsurance prices went up, some primary insurers passed costs through, others couldn't and exited. Done. That gets you about a third of the way to understanding what's actually happening. Let me take you the rest of the way. The hidden wiring runs through three structures that almost nobody outside the industry talks about. The third one is the part that should worry you about the whole American financial system, not just Florida and California. First structure, the reinsurance death spiral. This is a phrase actuaries use among themselves and almost never in print. It works like this. When primary insurers face higher reinsurance costs and either can't or won't pass those costs through to consumers, they have three options. They can shrink, they can restrict, or they can cherry pick. They tend to do all three at once. They stop writing new policies. They non-renew the worst risks in their existing book. They raise rates on the moderate risks they still cover. The good customers, the people in the safer zip codes, in the newer construction with better fire suppression or better surge protection, those people get the calls and the renewal notices and they're fine. The bad customers, the older houses in the wildfire corridor and the surge zone, they don't get renewed. They get pushed into the secondary market. The secondary market is smaller, weaker, more lightly regulated, and over time it can't handle them either. Where do they end up? They end up in Citizens Property Insurance in Florida and in the California Fair Plan in California. Both are state-affiliated insurers of last resort. Both were created decades ago to handle the small minority of houses that couldn't get private coverage. Both are now ballooning. Citizens, which had a few 100,000 policies in the early 2020s, peaked at something like 1.5 million policies a couple of years ago. The California Fair Plan, which had a small book historically, has roughly tripled in size in 5 or 6 years. Both of them are taking on the worst risks in the entire state, and only the worst risks, because anybody with options has options. Second structure. The death spiral compounds. Citizens in the Fair Plan have to charge premiums that are, by statute or political pressure, well below what the actuarial cost would suggest. They are systematically subsidized. Where does the subsidy come from? In Florida, if Citizens runs out of money, which it would in a major hurricane scenario, there is something called an assessment, which is a surcharge that the legislature is empowered to levy on every other insurance policy in the state: auto, boat, commercial. The deficit gets socialized across all Floridians. In California, the Fair Plan has a similar assessment mechanism, so you have a state-affiliated entity, by design uneconomic, growing rapidly, concentrating the worst risks in the state, with the implicit guarantee that any losses get distributed across the entire insurance base. That implicit guarantee is the most underpriced put option in American finance right now. Nobody on Wall Street talks about it. Nobody puts it on a balance sheet. It is just sitting there. Third structure. This is the one I called the insurer of last resort trap earlier, and I want you to understand exactly why it scares me. I'm going to pull on something Carolyn Kowski has written about. She's an insurance economist. She's been one of the few academics who's actually been honest in print about the structural problem, and extend it. As private insurers exit, more risk goes to citizens and the FAIR plan. As more risk goes to those entities, their concentration of bad risks grows. As their concentration grows, their probable maximum loss in a major event grows. We are now in a situation where, in a sufficiently severe hurricane scenario in Florida, citizens' losses could exceed $40 or $50 billion. The state's ability to assess that across the rest of the insurance base, to socialize that loss, has political limits. When you raise everybody's auto insurance by 20% to bail out coastal homeowners, the inland voters get angry and the legislature gets nervous, and at some point the assessment mechanism hits a political ceiling that is lower than the loss number, at which point the state itself absorbs the difference. And the state of Florida, depending on the year, runs surpluses or modest deficits. It cannot absorb a $50 billion shortfall. It would need to issue debt. The debt would be backed by what? Future tax revenue from a state whose property tax base just got destroyed. That is the loop. That is the doom loop nobody is talking about. And I want to come back to a thing I said earlier and complicate it. I told you the climate is going around the Maginot Line. That's true, but it's not the worst part. The worst part is that the structure we built specifically to absorb climate-related insurance failures, citizens, the FAIR plan, the assessment mechanism, those structures are themselves exposed to climate. They become more exposed every year. The insurer of last resort is supposed to be a small relief valve for an otherwise functioning private market. When it is 40% of the market, it isn't a relief valve anymore. It is the market. And the relief valve, by design, has no relief valve of its own. There is a beautiful and terrifying analogy from banking that I want to drop here. In 1983, Diamond and Dybvig wrote a paper that finally explained why bank runs happen. The short version is that a bank, by maturity transformation, is always insolvent if everybody shows up at once. The bank works because not everybody shows up at once. The state-backed insurer of last resort is the same thing in reverse. It is solvent only if the bad event doesn't happen. It is, in a real sense, a slow-motion bank run waiting for a trigger. The trigger is a hurricane. The trigger is a fire complex, like the one that hit Los Angeles in January of 2025. The bank run, when it happens, is paid for by every other insurance policyholder in the state, and when their pocketbooks run out, by the state itself, and when the state's pocketbook runs out, by the federal government. We are about 3 trigger events away from the federal backstop conversation becoming explicit. It has been implicit for 10 years. Let me give you a number that I think tells the whole story. The Tampa Bay region, the area around Tampa, St. Petersburg, Clearwater, has not been hit by a major direct hurricane in roughly a century, not since 1921. The probability that this continues indefinitely is, in any reasonable model, 0. When that storm comes, and Hurricane Idalia in 2023 was a near miss, and Helene in 2024 was another near miss, the insured losses will be somewhere in the range of $75 to $150 billion. Citizens is among the largest insurers in that region. Read that sentence again. The state-backed insurer of last resort, the one whose losses get socialized, is deeply exposed to the part of Florida that is overdue for the kind of event that would destroy any private insurance market. Here is the closing thought I want to leave you with, because I want you to feel the weight of it. This whole architecture, the global reinsurance market, the primary insurers, the state regulators, the insurers of last resort, the assessment mechanisms, the political pressure on rates, this whole architecture is one large slow-motion bet that the next big storm or the next big fire happens later rather than sooner. Every year that passes without the catastrophic event makes the system feel like it's stable. Every year that passes makes the eventual loss worse because the exposed value keeps growing and the underlying risk keeps drifting. The system is not stable. It is, in the precise technical meaning of the word, metastable. It looks fine until the moment it doesn't. And the moment it doesn't, a lot of structure that nobody thought was load-bearing turns out to have been load-bearing. Next time, we will talk about what happens after the system breaks. There is a question about whether private insurance for catastrophe-exposed property is even a viable financial product going forward, and whether what's coming is something that looks more like federal flood insurance, federally backstopped, deeply subsidized, structurally insolvent, applied to wildfire and hurricane risk. There's also a question about what this does to the property values that the entire American middle-class wealth picture is built on. That's its own conversation. We'll get there.